The past trading week demonstrated the need for faster risk-on, risk-off market models. If you'd like to watch this video in full screen mode, you can click in the lower right-hand corner of your video player. Last weekend, we showed various reasons to remain bullish from an intermediate term perspective. However, during the trading session on Tuesday, it looked as if the bears were taking control of the market. Then, in the final hour of trading, the Wall Street Journal ran a story stating the Fed was close to doing more for the economy. The market moved back into full risk-on mode Thursday morning before the open when the ECB said they were ready to do whatever it takes to preserve the euro. In this video, we review two risk-on, risk-off charts, potentially bullish setups in the euro, 18-plus traditional charts, and we close with Demar charts for bonds and stocks. In an article posted late Friday, Bloomberg indicated progress is being made on reinstituting a European bond buying program. However, not all ECB members are on board yet. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is one of many risk-on, risk-off charts that we use in the Schiavocco Capital Management market risk model. You can learn more about it on our website. There's a video in the upper right-hand corner. We've been over this before. This is the S&P 500 or SPY ETF divided by the aggregate bond fund ETF, AGG, risk on relative to risk off. Just looking at moving averages here, we've actually taken the ratio itself out of the picture so we can focus on trends and moving average crossovers. When the blue moving average crosses over the red, tends to be bullish. This is the S&P 500 weekly. Stocks did well after that point. Bullish cross. Stocks did well after that point. Bullish cross. Stocks did well after that point. We recently had a bullish cross earlier. We also, this week, went below in a bearish manner, but after the Fed and ECB comments late in the week, the weekly chart finished looking bullish. This looks similar here to this period here, this period here, and this period here. As long as this moving average, the blue, stays above the red, we'd also like to see the slopes of these lines pointing up as they are now in a bullish manner. This leans bullish for stocks and commodities, as long as it holds. This is a chart that we've also studied in previous videos. This is an advanced decline line on the New York Stock Exchange based on volume. Here's the AD line here based on volume. This is the 50-week moving average in blue. The things that we're looking for, we'd like to see the AD line move above the 50-week as it happened here. It's a weekly chart of the S&P 500. After the bullish cross, stocks did well. After a bullish cross here, stocks did well. After a bearish cross here, stocks did poorly. We have a bullish cross here, and another development is the 50-week moving average is turning up in a bullish manner. Like all the charts that we have in our models, as long as this holds in this manner, it's bullish. We have to keep an open mind and remain flexible. This turn here tends to be good. Here's a turn here. Stocks did well after that point. This is a daily chart of the euro currency. Got price making a clear lower low here over this period. The relative strength index, or RSI, has a bullish divergence that's been in place for almost 2 months. On the weekly chart of the euro, we're making clear lower lows relative to early 2012. RSI over that period has remained steady. The other point is, if you went back and looked at this chart previously, RSI had a tendency to go into the oversold region, which is in this blue box here. Oversold is below 30. We've remained above oversold, which tends to be a positive, and we should keep an open mind relative to at least an intermediate term rally in the euro. Now we're looking at a weekly Demar chart for the FXE Euro ETF. Demar charts and indicators are proprietary tools from Market Studies, LLC. Quick point on this chart, we have a 9 and a 13, which signals potential exhaustion. So much like the divergences that we just looked at, the Demar count on this weekly chart tells us to be open to a possible rally in the euro. This is a daily Demar chart for FXC, the Euro ETF. We also have a 9 and a 13. With this close here, we have what's known as a bullish price flip. We closed above the close 4 days back. That's 1, 2, 3, 4. Has a tendency to improve the probability of this 9 and 13 being meaningful relative to a possible rally. At any time, if you'd like to examine a chart more closely, you can pause the video here in the lower left-hand corner of your video player. This is a monthly chart of the NASDAQ. Markets tend to be healthy when they're above the blue line, when the slope of the blue line is positive. That's where we stand as of the close on July 27th. These are European financials that we've been tracking for some time. These are the lows that we wanted to hold. We came down again recently. RSI here doesn't look too bad relative to coming down. We broke above this downward sloping trend line here. So all in all, after a rough week, this chart looks pretty good. This is foreign stocks, EFA. We remain above this upward sloping pink neckline or trend line, all things being equal. When we're above it, markets are relatively healthy. This is the second version of EFA that we've been watching. We are now back above this trend line here that we were concerned about. Tends to be a good sign. RSI on a weekly chart is moved back above 50. And this Williams %R, which is an indication of momentum, this height here relative to this height here looks pretty good since this high was higher here. So this chart doesn't look too bad as of the close on Friday, July 27th. This is a daily chart of the Dow Jones Industrial Average. We've got an upward sloping trend channel and or an uptrend. One of the concerning things that we've seen short term on numerous charts, this is RSI for the Dow on a daily chart. We'd like to see RSI break out to new highs here. This is a short-term divergence with price. Not overly concerning that it's there for one day. If it's there for 2 or 3 days, that's not too bad. We'd like to see RSI on all these charts get above 63 and better yet above 65. In the markets, there's always something to be concerned about. This is a weekly chart of the New York Stock Exchange Composite. You can see this downward sloping trend line may act as possible resistance. We'd like to see this cleared. This is a similar look of the NYSE Composite. Downward sloping trend line in place. One good thing is we did clear the 22-week moving average and close above it. Next thing, we'd like to see this blue 22-week moving average turn up. This chart is relatively mixed, but a good sign that we closed above the 22-week. It's another chart that we've been watching for some time. We've been hypothesizing that good things tend to happen when you're above these two blue lines. We came down this week in a scary moment and tested the upper blue line, and it held. All things being equal, we'd prefer to be above this blue line, which is the 50-week moving average. Currently, price is above the 50-week, and the 50-week is trying to turn up in a bullish manner. Daily chart of the S&P 500. Trend looks good. We still need to see this RSI move on to make a higher high. I'd like to see this 61 turn into a 63, or better yet, a 66. If you look at a daily chart of the S&P 500 using only closing prices, this trend line here is important, and we have cleared it now twice. We also cleared above the top end of this trend channel here on Friday. This is a daily chart of the S&P 500. We're looking at this downward bearish move from this point here to here. These are retracement levels for this move here. Typically, if this downtrend were to extend, you would expect the retracement to stop either here, here, or here. We've now cleared all three of these typical retracement levels, at least using closing prices, which leans bullish. 3 quick points here that we discussed on our blog short takes earlier in the week. Intra-week, things look scary this week. The market did hold at a logical level. There's 3 reasons why it held at a logical level. This is a downward sloping blue trend line here. What once acted as resistance acted as support here this week. This is the trend channel that we've looked at before. We knew that this high was here before this low. You would expect the market to hold at this pink trend line, and it did. It held right at the pink trend line, which is parallel to this one. If you look at retracement levels for this move from here to here, one of them, 32% retracement, is down to this orange line here, and we held there. So we held at 3 logical levels intra-week. We showed on a closing basis that we've cleared this downward sloping trend line. If you use intraday prices, we still have a hurdle to potentially cross just below 1395 or somewhere in the neighborhood of 1400 in here. This is the monthly rate of change chart that we've been looking at for some time. The rate of change is well above the 0 line here, which tends to be bullish. When you break below the rate of change line here, it tends to be bearish. We also looked at previous corrections. Once we had a positive month, stocks recovered. Once we had a positive month, a new uptrend was in place. We had a positive month in June. The S&P 500 was up 84 points. In July, as of the 27th, we're up 23 points. If we can hold the gains, the monthly gains, into month end, I believe there's only 2 more trading days in the month. That would be another feather in the bull's cap. We've been using this chart for some time, a monthly chart of the S&P 500. We hypothesized that if you can remain above 1354, that it opens the door potentially to 1440. Here's the candlestick this week. We were able to recapture 1354. As long as we stay above it, it leans bullish. This week we also recaptured this dotted green trend line here based upon this high. You can see here we closed above it this week, all things being equal. That's a good sign. We may be moving towards this upward sloping trend line here, which would equate possibly with the 1440 level that we've been talking about. We've got some white space in here. Markets have a tendency to try to fill white space. This is a daily chart of VEU. RSI is approaching 60, which is a good sign. We did break a short-term RSI trend line here on Friday. We had this somewhat of a triangle formation here. Looks like we got a bullish break on Friday. We're still above this upward sloping pink trend line that we've been following for weeks from the October low. We've got a 50-day moving average right here trying to turn up in a bullish manner. That's the red line. The 20-day moving average has turned up in a bullish manner. Price is above it. The pink line is the 200-day moving average, which is also trying to turn up. We did close above the 100-day just by a penny on Friday. If we can break into this area here, obviously that would be a good sign. This is another weekly chart of VEU that we've been tracking for quite some time. Still a mixed picture. We were able to break above this trend line this week, which is a good sign. We also broke above this downward sloping trend line. The 22-week moving average, which is this blue line here, is still rolling over in a bearish manner. We'd like to see price get above it, and then we'd like to see it turn up as it did here, and then price went on to make a bullish move. The best news for the week may be that we finally got a bullish MACD cross on the weekly chart of VEU, the Vanguard All-World Index, sans the United States. You can get some whipsaws here with MACD, but you can see even when we had a whipsaw here, it was part of a bottoming process, and then prices went on to make higher highs. ADX still mixed down here, red above green. That tends to be bearish. This is turning up, all things being equal. That also leans bearish. Intra-week, the VIX made a move into this territory here. By week's end, we closed back down below these moving averages, which is good for the bulls as long as it lasts. We also have a bearish PPO cross here, which remains in place on the weekly chart of the VIX. A bearish signal on the VIX tends to be bullish for risk assets. We also still have a negative or bearish slant on this histogram for PPO. We've been talking about commodities with divergences and looking at it for several weeks. Commodities, DBC, the ETF, is now clearly in an uptrend. We published an article a few weeks ago highlighting bullish divergences in crude oil and oil stocks. We own both. Both are doing well. This is clearly now in an uptrend. It's a good sign to see the emerging markets trying to break out. You can see the emerging markets have not made a lower low since June, which is a good sign. This is a relatively long consolidation period here, lasting almost 2 months. If we can go on to make a higher high here, that would be a good sign for the emerging markets and China. Speaking of China, the main point here, if FXI can clear this dotted line here and move above 34.25 roughly, or this high, that will meet the formal definition of a trend change. Downward sloping trend line. Step 1, we broke the trend line. Step 2, we made a higher low relative to this low. Step 3 is we need to make a higher high above this high here. Some other good signs, RSI is above 50. It's a relatively healthy looking RSI compared to some of the other charts, considering we have not made a new high yet. MACD histogram has also stayed in the bullish end of the spectrum on the daily chart of FXI China. If you're a bull for risk assets, the fact that gold is showing some signs of life is a good sign. You can see here, gold has made a higher low, a couple of higher highs here. This week we also broke above this potential area of resistance. The moving average cluster is pointing up in a bullish manner, and we've got MACD histogram looking relatively healthy here. Relative to other charts, this RSI on the daily chart of GLD looks positive. Not sure gold is the best place to be, but it's on our radar, and we're more than open to adding gold to our portfolios. One of the laggards that we'd like to see catch up is basic materials stocks. The good news is we haven't made a low in IYM since May. We do have this long consolidation period here. We'd like to see this RSI break out to the upside. We'd also like to see price get into this area here. Best case scenario would be to exceed this high here on IYM daily. We've talked about bullish divergences in copper for some time. Copper is trying to form an uptrend. You can see this channel here. It held at a logical area here. Logically, you could see JJC potentially make a push into this area here. It's a chart we've been watching for several weeks. This is a basket of commodities divided by stocks. This is a positive development. This breakout here, this is still positive. One possible negative in the short term is RSI closed below 50, making it look a little bit more like this period rather than this period. This is what we want to see. We want to see RSI remain above 50. We'll just make one point here. This is the stock market, the S&P 500 divided by the TLT ETF. We'd like to see this ratio next week make a higher high here, which would be good for risk assets. Like gold, silver is showing some signs of life. You can see this is a higher low relative to this low. We also had a little bit of a breakout on Friday. Like GLD, SLV has a relatively good-looking RSI when you compare it to equity markets. This MACD on the daily chart also is favorable when you compare it to many equity markets. Good idea to keep SLV on your radar. This is a mixed chart on VTI. Obviously, this is a bullish breakout. Here, this neckline held, which is a good sign. That's bullish. We remain above this downward sloping trend line. That's bullish. We'd like to see these RSIs improve on all these charts. Like to see VTI's RSI move first above 63 and then above 65 on a daily chart. This is the daily Demar chart for the long-term Treasury ETF, symbol TLT. We looked at this chart roughly a week ago and said if TLT went on to make a higher high that we would get a 13. We did indeed get the 13. It appears that the market has reacted to the 13 in a bearish manner. We have what's known as a bearish price flip here. Here's the close, 1, 2, 3, 4 days back. We're below the yellow bull-bear demarcation line from a momentum perspective on propulsion, which means this downside target of 125.04 is more realistic in terms of probabilities relative to the upside target of 134.43. The other thing to note, these are TD lines, or DeMarc trend lines that are drawn systematically, so there's no bias in them. They're programmed. You can see we have a clear break of this upward sloping trend line here on Friday. This is a daily DeMarc chart for the S&P 500 index. Similar to the chart of TLT, we have a bullish break of a TD line or DeMarc trend line here on Friday. Maybe difficult to see, but we're above the yellow momentum demarcation line here, which says that this upside target of 1440 on the S&P 500 becomes realistic. This level at 1403 represents potential resistance from a DeMarc perspective. Wouldn't be surprising to see 1403 provide a little bit of stall or bounce back here. If we clear 1403, especially on a protracted basis, that would be bullish. If you find these videos helpful, we would appreciate it if you would share a link to the page that you're on now. To do that, take your cursor, left click, drag over the address, then hit Control-C on your keyboard to copy. Then move to the document or email that you would like to paste the link into, click on it, and hit Control-V to paste the link. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.